We're back on Morning Trade Live. We'll get a status update on the state of Nike's turnaround plan under CEO Elliott Hill when the company reports earnings after the bell. Analysts are expecting earnings of 28 cents per share for the trailing quarter on revenue of $11.2 billion. Shares rallied 15% 3 months ago after the company fourth quarter earnings report. Let's take a look at some of the other names in this space, and we've got Nike 0.8% lower today ahead of that all-important report card, but all the rest are down as well. Lululemon shares are down 0.5%, Deckers Outdoor 2% lower, and On Holding, which has been seen as a competitor there directly to Nike, down almost 3%. Let's go inside out on Nike earnings ahead of this report card. Joining us now, very pleased to say, is David Swartz, Senior Equity Analyst, Morningstar Research Services. Thanks so much for joining us, Dave. Nice to see you there. What are your expectations?
Yeah, the quarter is probably not going to be a particularly good one. Nike has been struggling, and so we're looking for a sales decline in the quarter of probably about 5 or 6%, and earnings of just about 28 cents, as you said, which is a low result certainly for Nike. This is a company that's used to strong earnings and strong growth, but we haven't been seeing that lately. But I think people are going to be looking past that. Everybody understands that Nike's in a turnaround situation now. Elliott Hill came in as CEO about a year ago, and it's definitely taking some time to fix the problems that have emerged over the last few years. But I do think that the company is showing some signs that things are getting better, and that's what we're going to look for this afternoon when the company reports.
What have you got to hear from Elliott Hill and the rest of the C-suite on that turnaround strategy? Because no doubt it is a very big ship to turn around. But what sort of are the key things, the metrics that you'll be looking out for?
Yeah, so Nike has released a lot of new products, and there's more to come. Nike has released several lines of running shoes in its main categories to try to meet the needs of all runners. And it seems like those shoes have been well accepted by the market, by retail partners. It's hard to say right now, how long it may take for that to really show up in the sales numbers. But, I do think that Nike is putting out better products now, and that they're fighting back against some of the competition from brands like Hoka and Ana that have taken share from Nike recently. And then Nike also just released its sort of long-awaited partnership with Skims called Nike Skims in the athleisure space. It just launched on Friday of last week. It had been delayed. It's hard to know right now how it's selling, but it does seem like it's a more competitive product that Nike's had in athleisure in the past. Nike has certainly struggled against Lululemon, and this is an attempt to try to take some share there because that is a very attractive market. And then if you look forward to 2026, next year we have the Olympics and then the World Cup. Those are going to be big marketing events for Nike, especially the World Cup since it's in North America this year. So, I do think that things are going to start to turn around in calendar 2026. We may not hear a lot about that today, but we'll see what we hear.
Yeah, I know the folks over at RBC have been pretty encouraged by the fact that they are involved in the World Cup. They also have at Nike a bit of a China problem on their hands. Obviously, we have seen the diversification efforts, to move some of that manufacturing, that exposure as far as supply chains away from that market. But as far as the consumer market is concerned, these Chinese brands are also giving Nike a little bit of a run for their money. Just wondering how you're looking at those two stories in that particular market.
Yeah, the Nike situation in China has been difficult now for some years. Nike products are mostly sold through franchise stores all across China. There are thousands of them, and they have been struggling. I think that youth employment being high in China has certainly affected Nike as well as other sportswear brands. And the competition from local brands like Anta and Li Ning and Xtep has also been a factor in recent years because they have put out stronger products than they had in the past, and they also have improved their distribution and supply chains, and that has been a challenge for Nike. But Nike is still the leader in the China market, and it's still a very attractive market with a lot of growth potential. Per capita spending in China on sportswear is about 1/10 of what it is in the U.S. And with the great population of China, there's certainly a huge market potential there as more Chinese consumers move into the middle class and start consuming sportswear and getting involved in athletics.
All right, we'll be watching, and I see your fair value estimate is $104 a share. So you rate Nike as undervalued there. We've got to wrap it up. Dave, always a pleasure. Thank you so much for getting us across your thoughts ahead of this all-important report card. We'll catch you later. Dave Swartz, who is a senior equity analyst, Morningstar Research Services. Appreciate your time. Let's trade it now with Tom White, host of Fast Market. And you have two bullish trades. Walk us through the call diagonal strategy for Nike ahead of these earnings, Tom.
Yeah, Sam, a couple different ways to get some upside exposure here in Nike, taking advantage of implied volatility levels between maybe the different option series. So the first one I'm looking at, bullish call diagonal here, where we're going to buy something 2.5 weeks out. We're going to go out to the October 17th monthly option, 17 days to expiration, and we're going to buy that at the money 69 strike call. It's got the higher delta. It reacts more like the stock, right? That's the bullish portion of this trade. And then against it, in the near term, October 3rd weekly options that expire in just 3 days, we're going to sell the 76 strike call. So a bullish $7 wide call diagonal. It's 2 weeks wide. You're going to pay roughly about a $2.80 debit for it. The debit you pay is going to be your risk on this trade. So $280 per spread on this. Anything above the 70 level is going to be profitability. Now, the option market's pricing in about a plus or minus 8% move in the shares, about $5.60 either way. This aligns with that type of move if you expect it to move about that one standard deviation to the upside. But anything above the 70 level is going to be profitability on this one. The key, why this thing is so cheap, it's $7 wide, and you're only paying $2.80 is because you're buying about a 58% implied volatility, selling about 130% on aggregate in the near-term options that you're selling. So bullish call diagonal here.
Okay, and have you got an alternative example trade for us on Nike?
Yeah, you still get that upside exposure. It's still a bullish trade, but we're going to look at something lower price, lower risk. So we're going to use those same that same differential between implied volatility for this call calendar to the upside, going out to that same October 17th monthly options, 2.5 weeks to expiration, buy the 75 strike call. That's about that one standard deviation move the option market's pricing in. And then in the near-term options, in the October 3rd weekly options, you're going to sell that same 75 strike call. So a 2-week wide bullish call calendar here, you're only going to pay roughly about 40-cent debit for it. So there's your difference, right? You get upside exposure for only $40 per spread. Now, the key difference between this and the call diagonal is you don't want this thing to move 2 or 3 standard deviations like it did last quarter where it went up 16%. You just kind of want it to hover near 75, but you've got a range between about 70 and 80 that you can still remain profitable on this trade. So a lower cost risk entry point on this call calendar with the expectations it's going to go up about 1 standard deviation.
Okay, a couple of example trades for Nike ahead of those earnings. Thank you so much for that, Tom White. Really appreciate your time.